Thank you for joining me again for the Providence Quarterly Update on the outlook for investment markets. Over the past quarter, global growth has held up quite strong despite some pockets of uncertainty. Within Australia, there are mixed messages within the economy that concern us, and we believe tail risks within the economy are increasing. Valuations across most asset classes are quite full in our view, and geopolitical issues are still very much front of mind. Therefore, for our clients, we are retaining a healthy buffer of cash and remaining well diversified across the portfolio. Despite the high levels of cash, however, returns for the financial year to date have been quite solid and above our expectations. We believe that the next year ahead is going to see increased volatility and be more difficult to achieve those sort of returns. Within the global growth picture, the US, despite a recent slowing down, is expected to increase the global growth, and that is why Janet Yellen from the central bank has indicated her intention to increase interest rates over the coming 12 months. Europe has also been performing better than many expected, and in fact their growth numbers of 1.9% is now above that of Australia's. Within Australia, the Treasury forecasts of 3% growth and increasing wage growth we think is going to be very difficult to achieve. This is against a backdrop of very low wage growth, underemployment within the economy, high household debt levels, and very high housing prices. Housing activity, we believe, will be a drag on the economy. Despite the buoyant global growth outlook, there are some mixed messages being given by different asset classes. Equities and property are certainly forecasting increasing earnings and increasing growth. However, the bond market is painting a different picture. Recently, bond interest rates have started to decline, indicating a potential slowdown. And the yield curve, which is the difference between the 10-year Treasury yields and the 2-year Treasury yields, has started to flatten. This is usually an indicator of slower growth in the longer term, and we'll be watching this quite closely. Within valuations across all the asset classes, we still are concerned that they are quite full and we're very late in the cycle. The US, for example, equity market is still trading on a very high multiple, not seen before until 1930 and back in 2000. So that's a note of caution. There also has been a big move into index funds. What that has done is pushed a number of stocks to very high levels and have dominated the performance of the US market. In fact, only 5 stocks accounted for over 37% move of the market last year. Europe and Japan equities look better value in our view. Within fixed income, credit spreads, the margin above the risk-free rate has contracted and come into an extent now whereby they're not factoring in any chance of recession and very little defaults. This is against a backdrop where debt levels are going up against the underlying earnings. Within property, we are still very concerned about apartment prices in Australia, and we believe some softness will occur over the coming 12 months. Within the direct property space, we are still focused on the boutique sectors of medical centres, education, and where managers can add significant value to the underlying property rather than just relying on the income from the property purchase. Within other alternative assets, there is still some value there to diversify and have non-correlated assets within a portfolio to protect it in increasing volatility, and that is a focus for our portfolios. One of the concerns we have is the rise of passive and index investing at this late part of the cycle. And this has led to an explosion of exchange-traded funds, or ETFs, in the marketplace, which now have a value of $4.5 trillion. Our concern here is that if there is a rush for the exits, it is going to be exacerbated by the ETFs. If you'd like any further information on that, we have done a white paper that can be found on our website. So from where we stand at the moment, we are still remaining reasonably defensive, retaining a high level of cash, very diversified across the portfolios, and always focus on the protection and preservation of capital. And just an update on some news within Providence. We're delighted to announce the marriage of Bianca and Brad. I'm very excited for them both and wish them all the success and happiness for the future. As for myself and Deb, we're heading off to Africa to do a safari and see the gorillas in the mountains. Hopefully we'll make it back safe and sound for the next quarterly update from Providence. Thanks for joining us. For a full report of our outlook, please see our website.